Hey everybody, how you doing? Mike DeAndre here. Today we are going to answer the question that millions have been asking. Has the market already pulled back and nobody noticed? Yes, that seems like an unlikely scenario, but one that recent data might suggest is absolutely the case. So let's take a look and let's see what we can learn by first reminding ourselves and observing what is the current state of the market. Equal sign is what is going on in today's market. Okay, that's important. We're going to start there. Next, we're going to take a look at sectors. We're going to peek under the hood and see what the sectors can tell us. And then we're going to finish up with the view of our classic stocks versus cash rankings and see what we can expect or have a reasonable expectation for moving forward. Okay, so if you can remember all the way back to July 14th, where for the next for a few days there, 5 days there, the equity markets pulled back fairly substantially. There was a couple scary days there, Monday in particular, where we went down from anywhere from 2.5 to 2.9% in those indices. And if we include the VIX, or a measure of volatility and risk, or a fear index, if you will, that spiked all the way up about 37.78% in a very short period of time. So I got a couple calls from clients, and I thought maybe it'd be a good idea to discuss where we are, see what's going on, and how we can address. And then, in fact, the question of this has happened, but maybe there's something under the current, under the hood that's going on that can give us some confidence moving forward. So when we experience reasonable pullbacks, even modest pullbacks, there's this tendency to want to go shopping at fear mongers. Okay, and we want to remember, and we want to anchor, and we want to latch on to the worst case scenarios that we've either experienced personally or read about, or granddad put us on his knee and told us a story about the Great Depression. Whatever it is, as soon as there's a tiny bit of fear, we start rotating out of euphoria and we get into a fear phase. It's very easy to latch on and stay in that environment. And we just have to remember that not every correction gets a t-shirt. Okay, not every correction is a life-changing, life-altering, terrible event. And obviously we go to great lengths on a risk management basis to prevent the contagion, if you will, of what's going on in the actual market from affecting your portfolio and protecting your retirement income or protecting your strategies that we've implemented. But we still have a intellectual context for the Great Depression, Black Monday, the dot bomb, and the Great Recession. And we need to suppress that and focus on our instruments, focus on our tools and our processes to say, okay, not did these happen and were these terrible things, but how do we navigate from where we are today? So that's really where we want to be putting our energy. Now, it is very important to be mindful and be vigilant and be observing when these corrections take place. Here's an interesting chart from Guggenheim, and it points out that while the corrections are relatively muted, that 5 to 10%, even leaking here into the 20% range, the number of declines are rather frequent. And this is going back to 1945. So there's been 78 5 to 10% corrections and about 27 10 to 20% corrections. The average decline anywhere from 6 to 13%. Average duration 1 to 4 months, and then time to recover 1 to 3 months. So we would look at those corrections as things that are very recoverable. In other words, if you have a 5% pullback, you need a 10% return to get back to even. That's not that high a hurdle, okay? But when we get into the steeper corrections, and your 20 plus and 40 plus corrections, they are fewer. But the pullbacks can be, the average pullback is much higher, 27 to 51%. The length of those pullbacks is anywhere from 11 to 22 months on average, and then the number of months to recover, 15 to 58 months. 58 months is a long time to wait to get your money back, and we don't want to experience that. So we have to have a way of separating out and working through a process of saying, okay, is this a normal and to be expected short-term brief type of correction, or is this the big one, wheezy, and I'm coming home? Okay, we need to be able to discern that so that we can position our portfolios accordingly. So if we look at where we are today, this orange line is pointing to, and that zero is basically saying we're at all-time highs. Once again, this is a spectacular chart. I use it all the time. Doug Short's website, Advisor Perspectives, and dshort.com. it shows us going back to 2009, the corrections and the steepness of those corrections over this time period. Anywhere you see this blue line hitting its head across the top, you can think of that as an all-time high in the market. But these yellow markers would represent your 5 to 10% corrections, and then these ones down here are your 10 to 20%. And then obviously we have something like the COVID experience, where I probably should make a T-shirt for that too. But anyway, we have the the COVID pullback of 33.92%, and it recovered so quickly that it didn't leave the wake that some of the others have. But where we are today, and what really matters, is that we're more or less sitting at all-time highs. So we want to keep that perspective as we're moving forward and thinking through this. And in case you're wondering, here's a fun fact that on Thursday, July 22nd, Business Insider magazine reported that Vanda Research found that retail investors bought a record of $2.18 billion worth of equities this past Monday during the sell-off in the market. So if you need an example of buy the dip, there you go. Market pulled back. It pulled back big, hard, and scary, and red, and ugly, and it brought in $2.18 billion of new funds, so to equities. So that is some interesting information. So let's take a look under the hood and see what's going on beyond just the big indices and beyond just the total U.S. market. So if you've never contemplated sectors before, just sort of a brief educational little interlude here. Total U.S. stock market, if we just take all those equities, put them in one big bowl, we can start parsing them out into individual groups, or sometimes they're referred to as the broad sectors or the broad groups. And you may have heard of these before as staples, just consumer discretionary, energy, financials, healthcare, technology, things of that nature. And there's anywhere from 9 to 12 of these, depending on whether you include real estate in your financials or how you break out technology. There's been some changes in the last few years, but generally speaking, those are the broad sectors. You can even go into subsectors, which are represented here by about 168 subsectors, everything from aerospace to water. You can get exceptionally granular, almost ad nauseum, by continually to segment out and break down the broad total U.S. market into individual sectors and sort of like stocks and like positions. But doing so gives you a flavor and a taste on where the market is, where's the strength, where's the weakness, and it can help you understand on where best to tilt and lean your portfolios. So in this conversation of sectors, it's probably a good time to at least just take a peek and say, okay, the core U.S. market, as defined by the S&P 500 on a cap weight basis, which simply means the largest stocks get the most votes, the largest stocks are going to have the largest participation in the index, would put us in a situation today where technology represents a third of the S&P. And then you have something like energy only represents 2.71% of the S&P. So that weighting within the broad index is important in understanding what we're about to show next, which is how has the year-to-date performance of these indices maybe created a sort of a smoothing of the correction that's been going on in the underlying positions. Oh, it's been interesting. Let's take a look. So what we have here are each of the market indices, the sectors that are those broad sectors that we talked about before, those broad groups. Basic materials, technology, healthcare, financials, real estate, industrials, utilities, energy, and consumer discretionary. And what we can see by looking at these year-to-date performance charts is that these red boxes, these red bounded areas, represent 5% or greater pullbacks. And each sector has had at least one, most have had 2 or 3 on a year-to-date basis. The only sector that is not included on this list is consumer staples, which has had some pullbacks, but nothing greater than 5%. So it begs the question, have these micro pullbacks, if you will, prevented a broader market sell-off? And while we won't know until we get a broad market sell-off, we don't know how long that's going to take. We got to believe that will eventually happen. But so far, it looks like some of the steam's been let out of the balloon slowly by these underlying sort of micro pullbacks versus getting a large significant pullback in the S&P yet this year. Let's now look at our broad rankings. So sometimes we get into a very persistently strong market and things don't shift around a lot. And some of these rankings look a little boring, frankly, because there's just not much going on. So I wanted to show a contrast from November of 2020, where things were, just as sort of a reminder. Well, today we have this very elegant look, which puts US core equity at 100%, and it puts cash at about 2%. And there could be really only two possible reactions to this. It's, hey, this is great. Core equity is doing awesome. Let's keep going. Or it's, oh my gosh, the sky is going to fall. Danger, 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 because equities can't go any higher. They're at the top. They're at the max. And oh my gosh, cash can't get cash is at the bottom. What these have to invert. These have to begin working back down. And in reality, they probably do. But what does that actually mean for forward-looking returns when equities are ranked this high? So let's take a look. Let's ask that question. Let's do that math. And fortunately, NASDAQ Dorsey Wright did it for me. And I will share it with you. So if we go from November of 2003 to July of 2021, and we use our percentile ranks, our decile ranks, and we want to observe how many days the core U.S. equity market has spent in these different percentiles. We can see that the stocks, U.S. stocks, have spent 56% of the days from November of 2003 to July of 2021 in the top 3 deciles, okay, ranked 70% or better. What are the forward-looking returns from the rankings in these deciles? Okay, so on a 1-month basis, a 3-month, a 6-month, and a 12-month basis, as long as the S&P has stayed above the 50% or stayed in the 50% or better decile, things have been great. In fact, on a 12-month basis, there's all double-digit returns. I would see this as a relatively positive historical look back. Doesn't mean that we just put things on cruise control and we stop doing our daily work, but there shouldn't be an automatic reaction that, hey, I'm running out the fear mongers and I'm buying the next t-shirt because the sky is falling. All right, that's just not a logical or responsible reaction to seeing U.S. equities in the first position or ranked at 100% of investable options. We have to remember, U.S. markets climb a wall of worry. Most markets, I'm sure, climb a wall of worry. And that we can see that when we look in practical charts. We just go back and we say, all right, well, let's look at the NASDAQ 100. Technology's been doing great. It's probably just been a straight line up, right? Well, it hasn't. If we go back here to the beginning of 2019, we see multiple double-digit. The smallest return, or smallest pullback rather, that's highlighted here is almost 11%. So these aren't 2 and 3% pullbacks. These are some substantial, and one of them is a 32% pullback. But we can see that the pattern of generally making higher highs and higher lows has continued, and the NASDAQ has continued, and in this case, technology has continued to do very well. It wasn't always the number one performing sector over this time period, but you could say its trend is intact. And if you wanted to get super technical, you could say it broke it and reestablished it here around COVID, or you could say COVID was an unnatural market event and we're just going to ignore it. Doesn't really matter. Where we are today puts us in a situation where we can say the market has continued to climb that wall of worry. Now, for the S&P, if we go back, here we are in about a year ago, into July of 2020, we see this blue line, which is the 50-day moving average on the S&P, and it has, for most circumstances, bounced off or stayed above that line. It has broken through a few times, but again, generally making higher highs and making higher lows. So that, by definition, is a very strong looking chart, a very good looking chart. Nothing that would suggest that we should be overly fearful. We need to be vigilant, but we don't necessarily need to be overly fearful of where things are and how they are positioned today. If we are to expect and we are to experience the normal 5 to 10% corrections, this is what they would look like. It would put us somewhere around 4,200 in the S&P or 4,000 in the S&P off of its last high. And it is, it's never fun when we experience these things, but it's kind of the freight we pay as investors. So I hope you have found this helpful. I hope this is something where you may have learned something new. If you'd like new information or additional information, or like just to ask us a question, say hello. You can always give us a shout at 240-285-9820. You can reach us at, or you can take a look at our social media blog on our website, deandrefinancial.com/media. Until then, I wish you well, I wish you the best, and have an excellent rest of the week.